If you've ever made money in crypto and thought, wait, do I actually owe the IRS? This is the video for you. Crypto taxes are one of the most confusing areas in finance right now. Even experienced investors get it wrong. And when they do, it really costs them. So I've been helping crypto investors navigate this since 2017, and we've processed over $1 trillion worth of crypto tax data. In this video, I'm gonna give you everything you need to know, not just the basics, the actual mechanics, the strategies, and the mistakes that can get really expensive. Number one, every transaction is taxable. Most people think crypto is only taxed when you cash out to dollars, and unfortunately, that's just not true. The IRS treats crypto as property, not currency. So anytime you dispose of it, it's a taxable event. That includes trading BTC for ETH, swapping tokens in DeFi, even that simple B2C to ETH trade, that's actually 2 taxable events. So here's what that actually means. If you've been actively trading or using DeFi, you might have hundreds or potentially thousands of taxable events. That sounds overwhelming, and yeah, it can be, but it truly is manageable if you understand how the system works. So the next question is, how does the IRS calculate what you owe? That comes down to one thing, your cost basis. Cost basis is the number everyone gets wrong. So at its simplest, it's what you paid for an asset, including the fees. Your gain or loss equals what you sold it for minus your cost basis. Easy, right? Well, not so fast. You buy ETH at $1,000. Then later you buy more at $3,000. Now ETH is trading at $2,000 and you sell 0.5 ETH. So which ETH did you just sell? The $1,000 one? Or the $3,000 one. So that depends entirely on your accounting method. You have FIFO, which is first in, first out, HIFO, which is highest in, first out. And this choice can literally change your tax bill by thousands. Now add multiple exchanges, wallet transfers, DeFi activity. Tracking this manually becomes nearly impossible. And this is where most people mess up, not intentionally, just structurally. Not all crypto income is taxed the same. So there are 2 main buckets. 1, capital gains, buying and selling crypto, trading assets, and 2, ordinary income. This includes staking rewards, mining, airdrops, getting paid in crypto. And here's the key distinction. When you receive crypto as income, it's taxed based on the value at the time you receive it. Then, if you later sell those same tokens, you may also have a capital gain or loss depending on how the price changed after that. For example, you receive $500 in staking rewards, so that's taxed as ordinary income. Later, you sell those tokens for $800, you may have a $300 capital gain. So it's not double tax on the same money. It's one tax event where you receive crypto and another one if the value changes before you sell it. DeFi's, NFTs, and staking. So this is where it gets a little more complicated. Providing liquidity into a pool is usually taxable. You're often exchanging assets for the LP tokens. Bridging. Moving assets across chains can be treated as a disposal, but in practice, it really depends on what's actually happening. If you're just moving stable coins, there's usually no real tax impact, but if you're swapping one asset for another, that is usually a taxable event. And one thing people miss, the fees you pay when bridging are often treated as a taxable spend. So with NFTs, buying and selling, that gives you capital gains. If you create an NFT and then sell it, the money you received is taxed as ordinary income. Staking. As of the recent IRS guidance, rewards are taxed as ordinary income when received. For airdrops, they're taxed when you have control over them, also called dominion and control. The value of the tokens at the time you receive them is really what matters. The key takeaway, most of the interactions in crypto have tax implications, even when it doesn't feel like a sale. Tax loss harvesting. This is how you legally reduce what you owe. Here's how it works. So you made $20,000 in gains this year, but you also have a coin sitting at an $8,000 loss. If you sell that losing position, your taxable gain drops to $12,000. Now, that could save you thousands of dollars, but don't take that to mean that you can automatically sell and buy right back in and assume there's zero risk. A more conservative move is to harvest the loss, then give it some time or rotate into a similar, non-identical position. Either way, this only works if you actually have visibility into your full portfolio. And here's what actually gets people in trouble. Thinking you don't owe anything until you cash out, ignoring small transactions, using the wrong accounting method, missing foreign reporting requirements, or simply just not reporting at all. And today, the IRS gets data directly from exchanges, so this isn't invisible anymore. So how to actually do this? Connect your exchanges and wallets, import all of your transactions, reconcile and categorize them, calculate your gains and losses, generate the tax forms to send to your CPA or import them into TurboTax. So the hard part really isn't the filing, it's reconciling everything correctly. That's where most people get stuck. If you've got simple activity, software can generally handle it. But if you have DeFi, NFTs, high volume, you may want some help. But once you set this up properly once, the future years get way easier. Now that you understand how crypto taxes actually work, the next question is, what specifically gets you flagged by the IRS? Because they're not just auditing anyone, they're looking for specific patterns. So click this video right here. I break down the 5 red flags that put crypto investors on their radar and how to avoid them. If you've got gains, DeFi activity, or unreported transactions, you'll want to watch that next. I'll see you there.